All right. Good evening, traders. Hello, everyone. Welcome to today's live trading session. And first, I want to say thank you so much for your patience. We had a bit of a delay starting this session due to this connection issues that we had because of the heavy rain in our area. I'm sure that a lot of you guys can relate to how the network or the internet issues start to shake when rain starts in Nigeria. It's like the internet decides to go on a break. But thankfully, we are live now and everything is back on track. And I also want to, thank you guys, every single one of you, for showing up and staying ready, even with the delay. It shows that you're committed, and that's exactly the kind of mindset that you need to succeed in this market. That's the kind of mindset that sets successful traders apart from, unsuccessful traders. Now, if this is your first time joining a live trading session with us or our webinars, I want to especially welcome you. You can go ahead and let me know your name and where you're watching me from. Even if this is not your first time, you're joining us for the second, the third, you're a regular participant of our sessions, go ahead and let me know your name and where you're watching me from. I'll just go ahead and read a quick disclaimer. Any opinion, news, research, prices, analysis, or other information discussed in this webinar or linked to this presentation is provided as general market commentary and does not constitute investment advice. Again, welcome to this session. Now, while you're telling me your names, I have to go ahead and also introduce myself for those of you that don't know me. My name is Ambrose Ebuka. I have 5 years of trading experience and I've honed my trading proficiency and contrived various profitable strategies that includes swing and scalp trading. Now, if you don't know what swing trading is or scalp trading is, in the course of this session, you would have the knowledge that you need to understand these different trading styles and why they're important to you as a trader. I also analyze gold, GBP JPY, and GBP USD charts with an outstanding accuracy exceeding 85%, and I regularly backtest trading strategies for effectiveness. Once again, welcome to today's session. Now, in this live trading session, we're going to keep things, very clear, very insightful, and very structured so that regardless of your trading experience, whether you're an experienced trader or you're just getting started, you'll be able to understand what's happening in the market today and why. Now, for the agenda, we're going to check the economic calendar. For those of you that don't know, Octa has an amazing economic calendar that keeps you up to date with the economic events. And today is a very important day in the world of trading. It's FOMC day. It's going to be happening in the next 39 minutes. We'll go ahead and explain that, what it means and why it's important for you as a trader. I'll also talk to you guys about the ZapZone strategy, which is the strategy that I use. Very simplified, very comprehensive. I would explain to you guys how you can use that as well. We'd look at the DXY, which is the dollar index. I would also explain how the movement of the dollar index would also impact some other currency pairs. We'd also have a Q&A session where you can ask me your questions and I can also ask you my questions as well, which is why it's important for you to pay attention. Okay, we have Thea and Ekram from Cape Town, South Africa. Good evening and welcome to this session. Everyone, welcome. Remember, this session is going to be for about 45 minutes. And remember to use the live chat to ask your questions during the webinar. I'm constantly checking the live chat to see if you guys have any questions, and I'll answer them all. Right. Let me know in the chat if the sound is good and you guys can hear me clearly so that we can go straight into today's session. If you can hear me clearly and the sound is good, let me know in the chat. All right, before we look at the economic calendar, I'm just going to go ahead and explain to you guys, the ZapZone strategy that I use, because when I go to the charts, I'm going to be doing some analysis, and it's important that you understand exactly what the strategy is about, how to use it, who it's for, when to use it. Most of the strategies that you learn, and there are a lot of strategies in the Forex market, but, most times you find strategies from different mentors, and then you can try out the strategy, but then it doesn't work for you, right? It doesn't mean the strategy is bad, but here are some things to consider. When you learn a strategy from a mentor and you're trying to practice that strategy, you need to consider what is included in this strategy. What does it consist of? Who is it suitable for? How does it fit into my trading style, right? When do I use this strategy? And what pair would I use it on? I can show you a strategy that works for gold, but if you try the strategy on, let's say, Amazon stock, or you try the strategy on a digital currency, let's say ETH, Ethereum, it might not work. So when you get an understanding of different strategies and you want to try them out, you have to first understand what is included in the strategy, what kind of trading style it is suitable for. What I mean is, if you're a day trader or a scalper and you use a strategy for a swing trader that requires you to hold that strategy or hold that trade for 2 weeks, 3 weeks, 1 month, you would find it difficult because that strategy doesn't align with your trading style. And then when do you use it? Do you use it at the open of New York session? Do you use it at an overlapping session? Let's say when the London session, overlaps into the New York session as well. When do you use the strategy and what pairs do you use it on? If you understand this, it makes it easier and more comprehensive for you to understand the strategy that you use. So I'm going to go ahead and explain what the ZapZone trading strategy consists of so that you can also use it in your own trading. Yes, the sound is okay. All right, thank you very much. So first, this strategy encompasses everything that you need to execute a trade, from the moment of getting into the market to the final decision of how much you want to risk on that trade to the point where you have to click on buy or sell. And the first thing is understanding market structure. Now, what this means is you being able to come into this market and instantly identify where the market is coming from and where the market is headed. So I'm going to throw this question in the chat and see if we have some people that can help us with the answer, right? Let's take off this hint. I'm going to go to the higher time frames. Let's say we're going to the daily time frame, right? All right, I'll take this out for a second. Now, this is a gold chart on the daily time frame. If you know the answer, go ahead and let me know in the chat. Where is this market headed? If you know the answer, go ahead and let me know in the chat. Where is this market headed? A downtrend or an uptrend? We've just come into this chart. Assuming you just, wake up, you're coming into the charts to see what's happening. You open gold on the daily time frame and you see this. What comes into your mind instantly? Are we headed upwards or are we headed downwards? Let me know in the chat. Let me know in the chat. So we are looking at this market headed in the upward direction, right? Now, if you don't know, just like, Michael locally answered in the chat, correct answer, we're headed upwards. Now, before you identify areas of, supply and demand, your support and resistance, your key levels, whatever it is you're identifying in this market, if you said uptrend, if you said it headed upwards, you're correct. Before you identify all those levels and all those areas of interest, you want to be sure and you want to instantly just spot if we're trending upwards, downwards, or the market is consolidating. And you want to get this information from the higher time frames, especially if you're a day trader. If you're a swing trader, you can go higher to the weekly and the monthly time frame. The weekly time frame still tells us uptrend. The monthly time frame still tells us uptrend. All right. Now, these different time frames, if you're just finding out about time frames, what this time frame tells you is for every time frame you go to, because this one here is the 4 hours time frame, it tells you that every candlestick you see here opened and closed within 4 hours. Every candlestick you see here opened and closed within 4 hours. If we go to the daily time frame, what it means is every candlestick you see here opened and closed within 1 day. A buy candlestick, a sell candlestick, it opened and closed within 1 day on the daily time frame. If you go further to the monthly time frame, still the same thing. it tells you each candlestick here is for a month. Now, you're not going to see a market moving in an upward direction on the monthly, moving in an upward direction on the weekly, moving in an upward direction on the daily, and you still go against it. It's an uptrend. You've identified the direction of the market. You've identified the structure of the market, where it's headed, the trend. This is the structure. It's an uptrend. An uptrend is made up of swing highs and swing lows consecutively. This is like a textbook illustration. It doesn't necessarily look as neat as this, just like you can see on the chart. It doesn't look as neat as this, but you're able to identify the highs, the lows, the highs, the lows. And obviously the previous highs would most likely serve as previous lows. Previous areas of interest would most likely serve as support for this market on the way down, just like this one served here. So back to the strategy. Now, when you're able to understand that direction, now you go forward to identify your key levels. Your key levels are your areas of supply, demand, support, and resistance, if you may. These areas of interest where the market has tested multiple times. An area where the market has tested multiple times proves that area to be strong. It creates and puts some kind of interest on that area. And the more the market bounces off, the stronger that area becomes. So your key levels can be your areas of supply, demand, support, and resistance. You can also use your trend lines as well to identify these multiple bounces that you get from this market. Now, the idea behind identifying patterns is not because you want to trade at that key level. So I'll give you guys an example. Let's say we go to give me a second. All right. So let's say we go to the 4-hour time frame, right? Obviously, there are a lot of lines here, and most of these lines serve as minor levels, like the red lines on the lower time frames, minor levels, the black lines on the higher time frames serve as my major levels, right? Now, when I identify these levels, which as you can see, I connect from the left-hand side, and then the market just tends to respect these levels on its way down and also on its way up. When I connect these levels, I'm not connecting them because I want to trade immediately the market gets there. It's for observation. The market did this sometime in the past. It created this high, it created this resistance, it created this supply. This level is an area of interest for me, which means I want to see what the market does the next time it gets to that level. All right, I'll give you an example. There are a lot of examples on here to give, but I'll just focus on the most obvious ones, right? You see this level here, area of interest, market movement, the market pushed all the way up, came back down, but it had already created this interest for me. So I mapped it out. And then what happened? On the way back up, it also came in to tap into that zone. The same thing for this consolidation that we have here, this, minor consolidation we had here before the market pushed back down, grabbed liquidity and went all the way up. You can see that this level served as resistance and support and got all these multiple bounces on this level. When you create and identify these key levels, it makes it simpler for you to know the areas where there will be potential retest. Now, as a trader, you don't want to go ahead of the market and say, whenever we get here, oh, because we bounced here, bounced, then we're going to bounce again. No, you want to see the market actually create and show you that bullish momentum that goes up before you say, all right, cool, we can bounce. I've seen momentum in the candlestick. It aligns with, my consolidation strategy, which obviously if you're trading consolidation strategies, you're looking at the market bouncing off at support and resistance, right? And then you trade in accordance with that. If you try to not just anticipate but move ahead of the market and say at every key level I'm going to buy, at every resistance I'm going to sell, at every support I'm going to buy, you could be caught up in what we call a fake out. A fake out is something that looks like this. The market fakes you out and then continues to go in the direction that you intended. How many of us have been in that situation where, you execute a trade and then the market hits your stop loss and starts to go in your expected direction? If you've experienced that, let me know in the chat. Maybe you placed a buy trade and the market went down, stopped you out, and started to move in the upward direction. Let me know in the chat. One of the reasons why that happens to you, and there would be a lot of reasons, but the most frequent reasons or reason why it happens to traders is because you neglect the higher time frames. You neglect, key levels and areas of interest on the higher time frames. If you're doing your analysis, identifying trends, identifying key levels on 15 minutes time frame, 30 minutes time frame, you're going to be blind on what goes on during the day, what goes on during the week. And the market creates stronger zones. As you can see here, you can see how since today we've been bearish on gold. You can see how the market just tapped into this zone and boom, all the way down. If you actually skipped all these movements and waited till the market got back to this point, you'd have, taken advantage of this movement, and that would have given you about, let's say, about 400 pips. All because you took advantage of the higher time frames. Even if you traded between these days, just because you went to the higher time frames and you saw that, oh, we had a level of resistance here and the market has reacted to that, I'm going to tap into this sell and capitalize on some profits. If you're trading on the 15 minutes time frame, you would not notice these things. 15 candlesticks on a 1 hour time, on a 1 minute time frame is one candlestick on a 15 minutes time frame. 60 candlesticks on a 1 minute time frame is one candlestick on a 1 hour time frame. So if you go to the 1 minute time frame and you're saying, oh, I want to look for the trend, that's just, the market can create 60 candlesticks, and that would just be one candlestick on the 1 hour time frame. So the market can be moving upwards, creating highs and lows on the 1 minute time frame. And if you go over to the 1 hour time frame, that's just a minor pullback of a bearish candlestick. Just like you can see here, you can see that the most recent candlestick today is bearish, right? But that bearish move, let me take this off for a minute so you guys can see clearly. That bearish move has been taken upwards by the buyers. Now, this candlestick that was full is now almost half. If you're on the lower time frame, like the 1 minute time frame, you might think that, oh, this is an uptrend, let me just buy. But in the grand scheme of things on the daily time frame, we're still bearish, we're still rejecting. And then you can get caught up in a buy thinking you're in an uptrend, and what happens? The market starts to push down to get to the low of this previous bullish candlestick. So you don't want to be caught up in that. You want to be able to identify momentum, identify these key levels on the higher time frames. And when you do that, you go ahead to predetermine your entry and your exit points. All these things, like I said, the ZapZone strategy, this is what is included in it. It takes you from your first understanding of the market all the way up to executing your trades. So now you want to predetermine where you want to enter this trade, and not just where you want to enter, but also where you want to exit. Your entry is made up of one factor: confluence, stipulations. Things have to align. It could be your trend aligning with a key level, and then you go down. The final form of confirmation for me that I use is candlestick momentum. I look at candlestick momentum to align with every other thing. If you're in an uptrend, I'm looking for the market to make a pullback. If that pullback is at the key level, I look for candlestick momentum and trade that. Your entry is made up of one factor, which is the confluence, your confirmation, but your exit is made up of two things. If you're trading these markets with only one form of exit, you're making a mistake. Your exit is made up of two things. The first thing is your area of risk, and the second thing is your area of profit. If you always look at the parts where you're going to make money from the market, you take profit, without identifying the conditions at which you're placing your risk, you're going to make a mistake, because if the market goes against you, that could put you in a very serious drawdown. So as you're looking at the good side, because obviously every trader executes a trade to make a profit. I don't think traders come to the market and say, I'm placing this trade because I want to lose money. Everybody wants to make money, right? That's fine. That's normal. But as you're looking at, oh, this is what's going on right now, this is where I want to execute and take my profit, you should also identify the area for risk. This is how much I want to risk on this particular trade. Now we can see that this consolidation that's happening here is also now happening here in the gold market. Let me just zoom in and show you guys. We can see how the market is now beginning to trade within this. You can also, for those of you that understand the pennant pattern or the triangle pattern, you can clearly see the formation of that pattern right now. Let me take this off so it's pretty clear for everyone to see. Let's make this a bit bold. And usually, what happens when the markets move in an apex? Who knows? Let me know in the chat. If you know what happens when the market is moving narrowly in an apex, what happens? Let me know in the chat. What happens when the market moves narrowly in an apex? Let's take this off. What happens? If you know the answer to that, let me know in the chat. For those of you that don't know, I'll give you the hint, right? If you still know the answer, you can go ahead and type it in the chat just so that we can save time. I'll just proceed to tell you guys what happens. When the market moves in an apex, right? When the market starts to move like this, the more it gets to the mouth or the ending point of that apex, the faster you're going to get a breakout. This cannot continue for long. The closer we get to the end, just like we're getting here, as you can see, the faster we're going to get a breakout. Now, obviously, if we're breaking to the downside, this is going to be the levels where you want to take your profits. 1, 2, and if you're taking 3 trades, then your final profit to be here, because these are also areas where the market could grab liquidity from. These are also areas where the market has created swing lows, potential tap-ins, right? And on the other side, we're looking at this area for your first take profits, your second take profits. And oh, that was a very funny looking line. But yeah, you guys, okay, let me just use this one. And then, you know, you're now seeing the market or expecting the market to come trade at this zone. But the point I'm trying to make here is, as the market continues to move narrowly, the more it gets to the end, the faster there would be a breakout. So as you're looking at gold right now, I'm telling you that there's going to be a breakout from this consolidation. And I've given you the areas where you can capitalize on these breakouts. Remember that you don't want to get caught up in a fake out. We are in an uptrend. This is the 15 minutes time frame. Whatever goes on here is still pretty much temporal. If the market is breaking down to this point, it doesn't mean that we are now moving to a downtrend. No, we're still going to be trading in an uptrend. If you break down even all the way up to $3,326 dollars per ounce, it doesn't mean that we're in a downtrend. Again, this is the 15 minutes. I'm going to show you guys, I'm going to highlight this place, everything that's going on here. I'll change the color to, let's say, green. Then I'll go to the daily time frame and show you what this whole thing is on the daily time frame. I'm pretty sure that if you see this market still push back down, it doesn't mean that the uptrend is invalidated, right? It still means we're still in an uptrend. If gold is able to push back down to the final point of our target, it doesn't mean that we're now in a downtrend. It's still, the uptrend is still valid. Okay, so when you're taking advantage of this breakouts, especially when you're breaking out against the trend, you have to keep in mind that it's temporal. Capitalize on the profit and expect the next opportunity. All right. And then on the other side, remember that we still have we still have this wick that is being created here. It's called a wick. It's spelled W-I-C-K. Oh. Or you can call it a shadow. And above this resistance point, above this level of supply, there are still orders that are here that the markets would potentially come up to fill. There is something called the weak fill strategy. What the weak fill strategy means is whenever you see the market creates a huge wick like this on the higher time frames, this long wick, there would potentially be a retest that fills at least 50% of this wick. So if we successfully break above this resistance level or this level of supply and successfully trade above it, then we're looking at the market trading all the way up to $3,465 per ounce on gold. Okay. And finally, you now want, after identifying your entry points, your exit points, you now want to apply proper risk management. How much do you want to risk on that trade? And this is very important for beginner traders, right? Risk management is important. If you're just starting this business, it's very important. If you're going to test how deep the water is, you're not going to put your two legs, are you? No. You manage your risk, identify how much you want to risk on a trade. And the goal of, trading is to, yes, you want to make profit, but for you to make that profit, you need to have money to trade. So the primary goal and primary objective of a beginner trader, and every trader actually, is to preserve capital. Right? On the end of the trader, on the end of the broker as well, you need to have capital, because when you have capital, it keeps you in the business long enough to keep placing trades. And if you're going ahead to risk 100% of your trading account, except you're okay with risking that and you don't mind, let's say you're okay with funding $500 and you want to risk that and just play around with it, cool. But if you're just starting and you want to understand the interface and how trading works, risk management is going to keep you long enough in this business to get the knowledge and the confidence that you need to now start funding more and trading more and making more profit. So it's very important. So that's what the strategy consists of. So what kind of traders is it suitable for? Now we have day swing scalpers and position traders. What it means is the strategy is suitable for all types of traders, regardless of your trading style. And why is that? The reason is because zones form on all time frames. There's always a zone in the 1 minute. Let me show you guys. So this is the daily time frame. Obviously, you guys have seen all the zones that I've mapped out here. Levels, areas of supply, areas of demand. You can see here as well. You can also see this level here as well. You can see this one as well. Now, if I go all the way down to the 1 minute, you can also see that we have support here. As you can see, there's a zone here that you can tap into if you want to capitalize on, let's say, 30 pips. Capitalize on the bounce. Boom. Right? So the zones form on all time frames, and that's why it's suitable for all styles of trading, all trading styles. Now, if you don't know what day trader is, day traders are traders that look to close their trades within the day. So the day trader comes into the market, analyzes, and looks to open and close their trade within that day. The swing traders can hold trades for days, for weeks, and even for some months. The scalpers are like the get in and get out type of traders. They don't want to waste so much time in this market. They just come in to trade, get in, spend a few minutes, and get out. Right? The scalpers usually focus on the 5 minutes, the 1 minute, and lower than that, 30 seconds, lower time frames. The position traders hold trades for months and even years. And that's why it's suitable for everybody, because even on the monthly time frame, you can still identify zones. Even on the 1 minute time frame, you can still identify zones. But whatever you do, I'll give you a quick tip, right? Whatever you do, even if you're a scalper, make sure that you understand what's going on the higher time frames. Make sure that you understand the overall trend, the overall direction. I'll give you an example, right? Let's say I'm looking at gold right now and I'm seeing all this noise. Obviously, I would want to capitalize on some of this small movements if I'm a scalper. But because I can go to the daily time frame and I'm seeing what's going on in the daily time frame, and I'm seeing that, well, this market is in an uptrend. We're seeing the formation of now a reversal pushing the market down. Whatever is going on here is going to be temporal. If it's a bearish move, it's obviously going to be temporal unless we break this structure, unless the market does something like this. And start to trade below this point. Then we can say, okay, this could be the market bending, and obviously if the market is able to come down to this point and even trade below this point, then the uptrend is successfully invalid, right? But that awareness alone that we are in an overall uptrend would help you guide the small trades that you're placing. Also going to help you know what to expect. So it's suitable for all trading styles. And when do you use it? During volatile sessions. Volatile sessions, I mean, the London session is the most active and the most volatile session in terms of liquidity. But we also have what we call overlapping sessions, right? If the London session opens by 9 a.m. Nigerian time, for example, and the New York session opens by 1 p.m. Nigerian time, each session lasts for 9 hours. So from 9, 10, 11, 12, London session is open. 1 p.m., now the New York session and the London session are both open. What does it mean? Volatility. And what does volatility mean for you as a Forex trader? Volatility means more opportunities. Volatility is the movement of the market. And if the market doesn't move, you can't make money. So you need the market to move for you to make profits. So you want to take advantage of these strategies during active sessions, or maybe after major news events like the one coming up in the next 9 minutes, the FOMC. Obviously, you don't want to get caught up in the swings, the wild movements up and down. You want to wait for the market to dance around, react to this news, and continue to move in its intended direction, and then you can capitalize on that move. So we're going to quickly look at the economic calendar. The Octa economic calendar. You can find it in Octa's official website under analysis and education, and you come down to analytics and click on economic calendar. Before I talk about the calendar, if you understand the analysis and also the strategy, the ZapZone strategy, let me know in the chat. If you understand what is included in it, who can use it, when to use it, let me know in the chat. So I was telling you guys that today is a very important day in the world of trading. It's FOMC day, and what it means is the US Federal Reserve would be making some key interest rate decisions. Now, I'm just going to give you guys a brief introduction to the Octa economic calendar. So you can, I mean, if you're seeing this for the first time, you can always set it up. And once you set it up, that's it, right? When you come to the Octa economic calendar, you want to first identify the time zone. You want to know the exact time this news would be released, right? So depending on where you are, you can set your region and it's going to update to fit into that region. The reason for this is you don't want to miss out on economic events, maybe because of the mistake in the time frame or the time zone. You now expect an event that has already passed. All right. So you also want to pay attention to the impact. Now, I already know about the low impact events and the medium impact events. So I always like to focus on the high impact events alone. Because just like the name goes, they bring about volatility to this market, high impact. Low impact would barely cause a ripple on the market, but high impact tends to make the market move. So like I said, guys, we have FOMC. If you don't know what FOMC is, Octa has also done a good job by providing the definition for this event. You can always click on it and find out what it means and how it's going to impact the currency that you're trading. In this case, this is going to impact the US dollar. Euro retail sales year over year would impact the euro. Fed monetary policy statements would impact the dollar. All right, so you can always click this, read the definition, and then pay attention to the last sentence. A hawkish view is considered bullish for the USD, while a dovish view is considered negative or bearish. How many of us know what hawkish and dovish is? If you know what it is, let me know in the chat. If you don't know what it is, you can still let me know, but you're about to find out. What do you think it is? Let me know in the chat. What is hawkish and dovish? If you know the answer, let me know in the chat. So while today is important because it's FOMC day, like I said, the Federal Reserve will be making, important interest rate decisions, monetary policy statements, and also a press conference. Now, these events that you see here, each of them have the power to significantly move the market, especially pairs, currencies that are paired with USD and gold as well. So I'm going to walk you guys, through what the FOMC is, why it's important, and how you as a trader can take advantage of FOMC itself. So today's focus is on the US Federal Reserve. As you can see, we have the actual, the forecast, and the previous, just as you can see right here. What this tells you is the previous reports that we had on this event, the forecast, what it's expected to be, and the actual. The actual is what it is at the point of the report being released. So as you can see here, interest rate decision 4.5%. What it means is the forecast is still 4.5%. It tells you that the Fed is expected to leave the interest rates unchanged. The forecast is the Federal Reserve or the Fed is expected to leave the interest rates unchanged. Then we have the Fed statement as well, which gives you ideas or clues about what the Fed thinks, economically. Are they seeing the inflation going down? Are they planning to cut interest rates soon? A hawkish tone, and I asked you guys about hawkish and dovish. Someone said bullish and bearish. Not exactly, right? So when the Fed is hawkish, they're trying to bullish and bearish is the impact, right? But when the Fed is hawkish, they're trying to increase the interest rates, right? They're giving an aggressive stance. It can make the US dollar to be strong. If they're dovish, they're looking forward to reducing and cutting the interest rates. They're going to sound a bit cautious, soft, and that can weaken the US dollar. All right. So by 7:30, obviously 7:30, when the chairman of the Federal Reserve, which is Jeremy Powell, that's when he's going to be answering questions. You can go ahead and expect fake outs, spikes, reversals. If you're an emotional trader, that's not the time to be trading. You have to wait for that market to move around, do all that reaction, and then you trade the original direction. Now, I know some of you will be wondering, you've understood exactly how to use the economic calendar, but these reports and this news, what do you do before and after the news? I'm going to give you guys a tip on what you should do before and after trading the news. And I'm going to do it on the live chart so you guys can see the market, how the market reacts to FOMC. All right. Let's put this at 14. So the first thing you want to do would be to mark your levels, right? It's going to be number 1. You want to mark your levels, identify your areas of support, identify areas of resistance. Support is where price have previously bounced and went up. Resistance is where price have previously rejected and went down. Look at the 1 hour time frame, the 4 hour time frame as well to get, a balanced view. I normally like to execute on the 15 minutes time frame and identify these key levels, right? The second thing you want to do is to observe the reaction to the first spike. So when the news is being released, and this is for all kinds of news, not just FOMC alone. When the news is being released, the market may shoot in one direction. That first move would most likely be a fake out. So wait and observe for about 15, 20 minutes before entering any position. Now, the third thing you want to do is to trade the retest or breakout. So for example, right, let's go to the 15 minutes time frame so I can show you guys that apex that we formed. Let's give it a second. Oh, we have to actually bring back the drawing. I don't think, do we still have it? Guys, it's raining heavily. Let's just copy this. Okay, so this is it. It's taking some time. Okay. Here we go. But that's much. Okay, so now, like I said, trade the retest or the breakout. Now you're seeing gold try to break out of the top, our resistance, our trend line resistance. What we're looking out for now is going to be, first we have this alignment up here. We're going to look out for the market to sustain that breakout and also create buy opportunities on the retest. If you just go straight, I'm more comfortable to execute a trade at a retest point instead of just a breakout, because usually the market can do something like this. As you can see this up here, we had a breakout. If you were caught up in that, you'd have placed a buy and then the market would have knocked you out. So we want to see the candlesticks close above this point, get to this resistance, because above this trend line is also an area of interest and a resistance level here. We need the market to get to that point, sustain that bullish momentum, potentially give us a retest, and we can now start to look for buy opportunities at that retest. If we get that on this stream, I'm going to go ahead and call out the trade for you guys with entry levels and exit levels. Now, the fourth thing while trading the news is you need to be emotionally neutral. All right, don't chase the spike. Don't try to guess the direction. Let the market show you, then you follow with precision. All right, don't chase the spike. Don't try to guess, oh, it's going up, let me just join, catch some pips. Let the market show you. Don't say, oh, because we broke above this point, I'm going to go for a buy, and then you start to see the market start to push down. No. Remember, the press conference is still at 7:30, which is going to be in about 25 minutes. So we still have things that could move this market and break us out of this apex. If you understood these guidelines, go ahead and let me know in the chat. And while you're trading the news, if you're trading with small accounts like $50 to $200, focus more on understanding the movement, not just the profits. Let me know in the chat if you understand these guidelines. Let me make it a bit bold so you guys can see it clearly. I don't think you guys can see this. So I'm going to quickly run through some risk management tips for you guys. You can always come back to this video to watch it. You can take a screenshot. This is very important for you, especially if you're a beginner trader. You want to get an adequate knowledge of the Forex market and its risks before you trade live. Backtest new strategies on your demo account before trading on a live account. Understand the impact of leverage. Work on your risk appetite. Use a moderate position size. If you're trading a small account, work on your position size. The idea is to, especially if you're a beginner trader, the idea is to get familiar with the trading environment, get a good strategy that can help you build confidence, and now you can start to gain more confidence in your strategies and also deposit more when you begin to see good results. Use a stop loss and a take profit. Choose a moderate risk to reward ratio. Don't use a 5% risk to chase 2% reward. Don't use 10% risk to chase 1% reward. Use a trailing stop on your trades to protect your profit. A trailing stop is when the market moves, let's say you're going for a 100 pips target and the market moves 50 pips. You can now set your stop loss. It's possible to do that. You can set your stop loss to break even, or you can set your stop loss into the profit so that if the market reverses, it can stop you out into the profit. So if you're targeting 100 pips and the market has moved 50 pips, you can put your stop loss now in profit of 20 pips. So even if the market reverses, at least you secured 20 pips. Control your emotions, do not overtrade or revenge trade, and know when to stop after consecutive profits. All right. When you have an amazing week, don't start to say, oh, you're the master of trading and now you want to go all in and risk 100%. Have a plan that tells you and gives you a target, and never risk more than you can afford to lose on a particular trade. All right. When you risk so much while you're trading and the market goes against you, you don't just lose money. Yes, guaranteed, if you make mistakes, you lose money, but you also lose some kind of confidence. And one of the things that will get you far in the Forex market is confidence. So you want to always have that in this market, which is why, as a beginner trader, focus more on managing risk so you can stay in this business long enough to even become profitable. Right about now, we're going to have the Q&A session. If you have any questions for me, you can go ahead and ask me the questions in the chat. I'll be happy to answer all your questions. If you don't have any questions, you should take advantage of the Octa trading app. The link is going to be in the description and also in the chat here as well. This app offers a wide range of trading instruments with low spreads, fast execution, and zero commission. It also has various educational resources, 247 customer support and the live chat as well, and strong commitment to funds and data security. Now, if you're going to make a deposit or you even have an existing deposit, you can always apply this promo code to it. The promo code is Ambrose E100. This is a promo code that gives you 100% bonus on your deposits. So when you're making your deposits through the Octa app or the official site, go to your profile, find the promo code section in the menu, enter the promo code and click on activate, and you can make a deposit and enjoy your 100% bonus. Now, there's a certain volume you need to trade to be able to withdraw your promo or your bonus to your bank account or to your trading account if you want to trade more and make more profit. But it's going to be indicated there the volume you need to trade to withdraw and redeem your bonus. So go ahead and let me know if you have any questions for me in the chat. I'm expecting to answer all your questions and make sure that you guys have a comprehensive knowledge of the financial markets. Let's go. Let's go. And while you're asking me the questions or preparing to ask me the questions, I'm going to talk about the summary. We're going to summarize today's session. We talked about the ZapZone strategy that I use, its components, suitability for you as a trader, and how you can apply this strategy. We also reviewed it on the live chart, showed you guys some key levels and how you can apply the strategy on the live chart. And we talked about some risk management trading principles, right? Now, I want you guys to live with this. While you're analyzing and taking advantage of the profits and the benefits of the forex market, make sure you analyze trading instruments to understand how they work and how they behave under various market conditions. Review your actions and reflect on your decisions to identify what works well and what can be improved on. Guys, accountability is very, very much underrated in the trading business. Why? Because you can make mistakes, and because you're not accountable to anyone, you don't even know how to move on from that. So make sure you're constantly reflecting to improve. Keep up with the latest market news and updates. You can use the Octa trading app, the Octa economic calendar to know what's going on, and use educational resources like this one you're watching right now to enhance your understanding of trading strategies and tools. I think we have a question. Ambrose, may I ask a novice question, please? If you want to pay out any amount you made or traded, is there a fee payable? When you trade with Octa, I don't know about other brokers, but I'm going to tell you about Octa because that's what I use. And you make a deposit, you don't get charged any fee for your deposit. And when you make a withdrawal, you don't pay any fees for your withdrawals. If you're withdrawing $100, you get $100. As a matter of fact, you don't even pay any fee for trading. You don't get charged any commission. You don't get charged any swap fees for holding your trades overnight. So, no charges on deposits, no charges on trading, no commissions, no charges on holding your trades for 10 nights, no charges on withdrawals. So I'm hoping that answered your question, Isaac. Let me know in the chat if you answered the question. So this one is from Adetunji. Can you please expatiate further on the usage of time frames, especially when they are showing different directions? How can one take the advantage? Now, in all time frames, there are opportunities, right? But like I said, the higher time frames, the daily, the weekly, the monthly, give you an understanding of overall market movement. So if the daily, the weekly, the monthly is saying uptrend, and the 4 hour is kind of showing a reversal, you want that 4 hours to align with what the daily and the monthly and the weekly is saying. It's all about comfortability. I'll be more confident in trading in the direction of the higher time frames because the big banks, the central banks, the people that control and move this market, even the hedge funds, liquidity providers, they are not busy on the 15 minutes time frame scalping. They are moving the markets in the long term. The trend lines that you're drawing, they create these trend lines. So I'm more comfortable to look at what's going on the higher time frames. And if the lower time frames are not matching that, I would want to see the lower time frames show me that they're moving in that direction of the higher time frames, and I trade with it. In the long run, it's not 100% guaranteed way to trade, but over time, it gives you more profit because you're trading in accordance with the trend and the overall trend of the higher time frames. So let me know if I answered your question, Mr. Adetunji. What's the buy? This is from Olawale. What's the bias on USDJPY? Guys, we're out of time, but let's see if I can do something in 1 minute, right? Let's see. USDJPY. Okay. Clear downtrend on USJPY. We're already seeing all these lower highs, lower highs, lower highs being formed here. Clear downtrend on USJPY. Right now, obviously, we're seeing what's going on with the US dollar. The US dollar is still pretty much on a downtrend, still tanking down. And I told you guys about key levels, and you can see how this level we identified here, Monday, 17th July 2023, the market has still come down to respect that. As you can see, 2 years later, we're still trading there, and the USD is still pretty much bearish. So USJPY, from what I can see, we're still in a downtrend. Obviously, now that I've extended this chart, you can clearly see that I can also extend this to this point, bounce off at support on the daily time frame. And you know that usually on the higher time frames, the support levels, the key levels generally on the higher time frames are usually very, very, very strong. They hold very much. They hold well. So we've gotten that nice bounce. Obviously, if the market was trading around this point with all these rejections, I would have given you an idea on what to do. But currently, we've created this high after this bounce, this swing high, which also aligns with the market movement here. I can still extend it to this point. It makes it an important level on the USJPY market. And as long as we keep trading below it and also potentially below this point, we're still bearish on USJPY. But let me go to the lower time frame and see if there's any indication for further downside. Yeah, bias on USJPY. We're still pretty much bearish on USJPY, guys. Still pretty much bearish. We still expect further downside. If you're scalping this market, you can take advantage of, 50 pips to 60 pips downside movement on USDJPY. How much, this is from Lingua, how much can an expert trader make in a month? Well, just like risk tolerance differs and income differs, your profit is also going to differ. Your profit is based on different things. Your trading amount, how much you're trading, your trading style, if you're a swing trader, a day trader, it's dependent on that and the kind of trading plan that you have. And also the instruments you're trading. So it varies, right? Your trading plan is what's going to tell you how much you can make in a month. Now, if you're a beginner trader and you're just starting, I wouldn't say you should focus on is a fixed amount per month. I would say get familiar with the app, get familiar with the instruments, the tools, give yourself time, a month, 2 months, 3 months, 4 months to track your progress and say, oh, in the first month, I made 20%, I made 30%, I made 5%. In the second month, it was 2%, it was 10%, it was okay. What did I do in the first month that gave me this much? I need to do more of that. It's a process, guys. If you take 1% risk, well, you can't be asking a question about profits and then you're using your risk as the factor. The question is about profit, right? You're asking how much you can make. You risking 1% doesn't determine how much you can make. The amount you can make from this market is unlimited, but the amount you can risk is fixed based on how much you want to risk. So, like I said, it depends on the amount you're trading, the instrument you're trading, your trading style. Are you a day trader, swing trader? Are you going to hold this trade for weeks? These are the things that you put into consideration, and you can only be confident in that specific amount after you practice it. Okay, so if you're asking me this question, it means you have not looked at a track record and given yourself incontrovertible evidence that you can do this in this month, second month, third month. You want to give yourself that time to practice and then review all these months to see which worked well, which worked the most, and what you should do more for that session. Hi, Mustafa. I would not be able to analyze GBPC 80 right now because of our time. But tune into the next session and hopefully you come early, you ask so I can analyze GBPC 80 in our next live trading session. Now, as we close this session, guys, thank you very much for participating anyway. As we close this session, I want to remind you of something important. It's a new month. We're on the 7th day of May. It's a new page, it's a fresh start, and it's an opportunity for you to approach your trading journey with renewed focus and fire. If last month was rough, let it go. If you lost some trades, lost some motivation, or even lost confidence, this is your cue to reset. You're here now. You're on the Octa Broker YouTube channel. You're learning, you're showing up, you're making progress, and that already sets you apart from the crowd. All right. Tell yourself every day, May is my month of clarity. May is my month of consistency and calculated moves, because you're not just trading with vibes and coming to this market to catch trades. You're trading with vision. Okay. So take a moment to fill out our survey because we value your feedback. It's important for us to improve our future webinars. It's going to take just 1 minute to do this. You can scan the QR code on the screen, or you can use the link in the description. All right. Thank you very much for being part of today's session. There's a link in the description that also takes you to the Octa Nigeria Telegram chat. There's also a link in the chat that takes you to our Nigeria Telegram chat as well. Until next time, stay sharp, stay safe, and stay learning.